Fantastic. I do apologize for a little bit of technical difficulty on that. So again, if you do have any questions, type them in. Thanks for a few people for confirming that the audio is back up. If you were booted out, you might have to re-log in, at least with the call or at least through the ReadyTalk audio selection with the plugin. So do make sure you do that. If you would like to get back in on the audio. So about us, again, we are nationwide and worldwide with regards to doing these kinds of things. So again, if you can dream up the type of investment you want to do, we can certainly try to make that happen for you underneath of a qualified plan. We have over 20 years of experience in doing these exact type of investments, so self-direction only is the business that we are in. We hold a little bit over $700 million of client assets under management presently, which represents a broad range of different types of investments, about 70% being based in real estate, including the checkbook control type of accounts. And the nice thing is that every single person who has an account with Advanta does have a dedicated account manager who can be the single point of contact for you. So you're not getting a different person each time that you're calling us for a question or an investment-related question as well. So if you do have any questions, we do have offices maintained in the states of Georgia and Atlanta, and our main office here down in Largo, Florida. By virtue of the fact that you are here today, you've already experienced part of our Learning Center. We hold many different events. We have an on-demand center, so we will be hosting the recording and the slides of this on YouTube. So please don't feel like you have to take copious notes if I'm going a little bit fast through a few of the sections on the slides. They will be hosted on YouTube, and you will get an emailed link to yourself, so that way you are able to listen and look at the slides after you have done that. I do have indication that people are able to hear me, so a few of you said they still have no audio. I would recommend either trying to redial in through the phone line if you were dialing in through the phone, or if you had to use the plugin through the direct ReadyTalk site, do try to dial back in through the computer audio as well, so that might alleviate the problem. So I am sorry if people are still having issues. And with regards to the few people with their hands raised, please do type in the questions if you have them to the chat box so that I can get those addressed as well. And one moment, let me just broadcast a few things to people that cannot hear. Okay. We're back to it. So what is a self-directed IRA? A self-directed IRA really isn't any different than any other IRA. Every single IRA that you can hold with any different bank or administrative custodial service is exactly the same in its DNA. So at its core, every single IRA is exactly the same. The difference is what the actual administrator of that account, or who you hold that account with, will actually let you invest in. So people that you're most likely used to are going to be doing stocks, bonds, and mutual funds. They could actually do real estate, and essentially, we could do brokerage, but we do real estate well, they do those things well, and neither one of us would do each other's business very well if we tried. So each person in this industry has their own specific function and really does have the ability to properly do the things that they are looking to do. And for people looking to do real estate, people looking to do private equity and things that are closely held, need someone with the experience like Advanta to properly do that and have the efficient workflows to help get those types of investments done. The simplest term is that you have the full control in order to make the types of investments that you would like to do, and without having to only be locked into a certain list that you're picking from of something like stocks and mutual funds. Now, with that said, there really isn't any difference to getting started with a self-directed IRA versus any other type of IRA. Most people like to use the term transfer and rollover interchangeably, but something I do like to put out to everyone is that there is an inherent difference between those types of movements of cash and assets. And the differences are very, very important. So just a little bit of record of definitions to get started with this. If you are looking to move money into an IRA, the cleanest and easiest way to do that is a custodial transfer. So if you have a like type of account with one administrator, let's say a traditional IRA, and you'd like to move it to another another traditional IRA administrator, what you do is called a custodial transfer. We submit the request to the resigning custodian. They move it directly to us. There's no tax implications. There's no reporting of the cash movement. It simply goes from one administrator to the other. It is the simplest and the cleanest way in order to move money. Now, the other term that a lot of people like to interject and interchange into this is what's called a rollover. A rollover is a very, very specific type of movement of cash and assets between two tax-qualified plans. The difference between that and a custodial transfer is that a direct rollover or a rollover does have tax reporting. The resigning custodian is going to actually be issuing Form 1099-R to the IRS, indicating that you have done a distribution of cash from that type of plan. Now, the technical way that they make sure that this is not reported taxable to you is what's called Code G, meaning a qualified rollover to a qualified plan. But you do need to make sure is that unlike the traditional rollover, that you do have tax reporting with this. So you will be getting a 1099 from the resigning custodian and tax reporting qualifying the rollover from the people that are receiving it. Now, people might ask, well, why doesn't everyone just do a transfer? Well, the rollover has its specific place insofar as that if you have a 401k, 403b, governmental 457, armed forces thrift savings plan, large pension, etc., you will need to use a rollover. It's the only way to go directly from a non-like type titled account, so let's just say from a 401k into a traditional IRA without paying any taxes or penalties. So it does have its place. It is something that is very specific, and I just like people to know that there are other options out there, and sometimes even options that will simplify it with regards to getting started with self-direction or any type of IRA for that matter. So it's just some good things to know. I hope people got a little bit out of that. You know, we're going to give you much more information, but that is a very good thing to know. It's the difference between one, a transfer, which is non-taxable, non-reportable, and a direct rollover, which is non-taxable, but is a reportable movement of cash. So now, what types of accounts are out there? The next slide we're going to cover is going to be the different types of plans for the most part that we handle, and for the most part that most people out there are going to be using in order to do self-direction. Now, keep in mind there are a few other smaller, a little bit more niche and specific types of plans out there that you can use to self-direct, but these are going to be the ones that are most often used, and I'm going to go into a little bit more about each one of them and how they function with regards to the kinds of contributions that can be made as well. Starting from the left, we're going to work our way over to the right with these plans. The traditional IRA is what most people are inherently very familiar with. It is the oldest of all these types of plans, being able to be first established in 1975 after the passing of ERISA, which guided the government into being able to allow people to self-save for retirement to try to ameliorate a little bit of the burden on Social Security. So a little bit of history on that, but you have been able to do this for a very long time. So it is essentially the most well-known and recognized type of plan out there. The traditional IRA has a contribution limit, just like the Roth IRA, of either $5,500 a year or $6,500 a year if you are over the age of 50 and a half. Now, the traditional IRA and the Roth IRA, the contribution limits to those plans are not capped by the rollover and transfer rules. So you can transfer $100,000, $200,000, $300,000 from another IRA to this IRA without affecting your ability to contribute money out of your own pocket from your own paycheck on any sort of given basis. The difference between the Roth IRA and the traditional IRA, since they are so similar, is only seen on the very beginning and the very end of these types of plans. It is whether or not you get a deduction for adding money into the plan, such as in a traditional IRA, and you get no deduction in for adding in on a Roth IRA. And the other difference is that the tax consideration of the monies once you distribute them personally from those accounts. So nothing to do with the actual investments, the life cycle of these accounts, the tax considerations being exactly the same in that instance. When you take money out to sit on a beach and enjoy your retirement, that is when you're going to see the differences between these two accounts again, in that the traditional IRA, you will be paying ordinary income tax, so you will get a 1099-R. You will be paying that in your claiming that on your adjusted gross income for your 1040. The second portion of that will be seen on the Roth IRA, where you will be paying no tax if it is a qualified distribution. So a really awesome part about that is essentially that you get to have tax-free money in retirement with the Roth IRA if you are utilizing that and growing that. So it's certainly a great type of plan to use. But again, it isn't for everyone. Oh, great. We have our first question. Stephen asks, if your self-directed IRA owns a rent-producing real estate, is the monthly rent income susceptible to the $6,500 a year max IRA contribution? Fantastic question, and it is not. So essentially what you're looking at here to kind of bring it down into a very basic term is that the return on your investment has no bearing on the contribution limit that any of these plans are going to be subjected to. So traditional and Roth IRAs having the $500 or $5,500 limit of contribution depending on your age, the rental property can be throwing off $1,000 a month in rent, and you be getting in $12,000 a year of income from that, and still being able to contribute $6,500 on top of that. Now, just keep in mind that that is only just considered tax-deferred return on investment income for your IRA, so it has no bearing on the actual contributions. But great question. Carlton asked, are the earnings in a Roth taxed at the point of distribution? No, that's the great part about a Roth IRA, is that any of the earnings that are going to be accrued during the lifetime of the Roth IRA, unlike with the traditional IRA, when you take any amount out at the end of its life cycle, it is taxed at ordinary income. The Roth IRA is so long as you've had the account established for at least 4 years and you are of the age of 59 and a half, everything that you distribute from that is not taxable at all. So really, really interesting way that those plans are extremely powerful. Moving on to the self-employed or small business plans are the SEP IRA, the not so aptly named Simple IRA, and the individual 401k plan. The SEP IRA is a plan that will be basing all of the deductibility that you are going to get for the extra contributions on the side of the business. So the way that these three plans work is that they are established for a qualifying business, and they have much higher contribution limits than the traditional and Roth IRA. The SEP IRA has a maximum contributable amount of up to $53,000 per year in 2017 currently. Now, how is that $53,000 made up? Well, you have a qualifying business. The business can elect to contribute a portion of the individual's salary not to exceed $53,000 on an annual basis, or 20% of that individual's base compensation, and the base compensation will max out for SEP IRA contribution consideration at $260,000 per year. So essentially, you're looking at that from the perspective of high-earning employees can make a very sizable contribution into these plans, but it doesn't necessarily always work for everyone. So you're creating a potentially $53,000 deduction on behalf of the corporation. The participant in that plan gets to enjoy a little bit of that insofar as that they are now essentially making less money, so they are not having to claim as much on their taxes, but they are not actually getting a deduction for the contribution into that plan. Okay, Tom, that's a great question, and I think it'll be answered in the next few points I'm about to make. The Simple IRA functions in a similar capacity to the individual 401k, whereas the SEP is wholly contributable and deductible on behalf of the business that is making the contributions into it. The Simple IRA and the individual 401k plan are both going to be split between monies that are being added as an elective deferral of compensation, so an employee that's participating in the plan deferring an actual portion of their pay into the plan and actually getting a deduction for that. With the Simple IRA, however, there are irrevocable elections that are tied into several year periods as to what the other portion of that is made up of, being the employer contributions to that plan, either being a non-revocable election to contribute 3% of profit into the plan annually for at least 2 years, or to base it on profit sharing of the net operating income of the business for at least 2 years as well. There are calculations that you have to do, and if you are an employee that is covered by a SEP plan, you cannot move or roll over that plan for at least 2 years. So there are a lot more rules with regards to Simples. They are inherently very not simple to administer, and the individual 401k kind of trumps that in a sense because you do have the ability to change things from year to year, make higher contributions, and create more deductions on both the side of the employee and the employer. So Tom asked, solo and self-directed, if I have a business on the side, would it make more sense to do a solo? Why or why not? Now, depending on how much cash you're really kicking out of that plan is really going to kind of determine the actual mechanisms of which one makes more sense. Tom, I'm happy to kind of look at that on a more personal basis. If you want to just catch my contact information at the end of this and give me a phone call, we can really look into that in depth. But it's something I could spend an hour in and of itself kind of going over the pros and cons of which one would make more sense. But essentially, he's just asking, if he has a side business, would it make more sense for him to use a traditional or a Roth or a small business plan? And it's inherently a very subjective question that has a lot of factors that need to be taken into account. Now, with the individual 401k plan, you have the ability to add in, on behalf of the employee up to $18,000 a year of compensation. And the thing is it can be 100% compensation contribution, meaning that if you're only paying out, if you're a self-employed individual, income subject to FICA taxes in the amount of $18,000 or $20,000 a year, you can contribute that whole amount into the plan, creating a personal deduction of $18,000 to help offset FICA. Pretty cool. The other portion of the contribution into this plan is based on net operating income of the plan, which can be up to 20% of net operating income of the plan, not to exceed $35,000. So you can potentially create up to $53,000 or $59,000 because you have the ability, if you are over the age of 50 and a half in an individual 401k plan, unlike the traditional and Roth IRA where you only get $1,000, you get $6,000 of additional catch-up as an employee, so as the participant of that plan, to add more money out of your paycheck on an annual basis, bringing your total contribution into that plan up to $59,000. And kind of the extra icing on the individual 401k plan is that you have the ability to make your personal contributions, so the $18,000 or $24,000, as either deductible, traditional type contributions, or non-deductible, Roth, tax-free growth contributions. So the plan has a lot of interesting facets to it. Unlike the simple IRA, you have the ability to change the amount you contribute from year to year, make no contributions on one side, max out contributions on the other. A lot of really cool stuff with 401ks. I'm actually teaching a whole class this Wednesday in Sarasota for about 2 hours just on roundtable discussions and interesting topics and things people need to know about 401ks. So if you're local to the St. Pete, Tampa, Sarasota area, I would encourage you to attend that class. Free to attend, going to be awesome. It's on our website, so let me know if you'd like some more information on that. The last two types of accounts that you can self-direct that we typically handle are your health savings accounts for individuals under qualifying high-deductible healthcare plans, and education savings accounts as well. The health savings account does have a different type of contribution that is going to be based on if you are a family or individual basis. Here's a snapshot that kind of goes over the education savings, 401k, simple SEP, traditional IRAs. So you can kind of see how it breaks down with regards to the actual contributions that you were looking at. Okay, Caesar asked a good question before we move on past the plans. In solo 401k, does one have to cover employees? So with the solo 401k, if you have rank and file employees, you do have to get a 401k plan from a different provider because there are very specific Department of Labor laws on what's called discrimination testing that has to occur within the plan, which essentially goes in and makes sure that the plan is being offered to qualifying employees and not discriminating against lower earning employees versus highly compensated employees for participation in that plan. One way that can be alleviated is that if your business has only equity owners, so you could have an individual 401k plan that covers all equity owners of the business. If it's only employees are equity owners, you could have 10 equity owners that each own 10% and have a solo 401k plan, and they could make the determination of whether they want to participate or not. It doesn't cost anything else. It's still the same administration for us. The other way to do it is that if it's only you and a spouse they can be covered under a solo 401k plan as well. Again, there's a lot of things that go into those with regards to the actual rules and regulations for them, which I could spend days kind of covering. But in basics, if you do have any sort of rank and file hourly employee, you do need to get a little bit more in depth with the 401k that you're offering if you go with that plan. The cheaper plans to administer if you have rank and file employees are the SEP IRA and the Simple IRA, just because they don't have as many regulations with regards to exclusion, and they have a much lower threshold of cost for administration, especially if you have a business that has hourly or rank and file employees. So investment options, kind of getting away from the the actual real technical stuff. Hope I didn't put anyone to sleep with regards to the plan options, the contribution limits, and everything. I find it very interesting, but it is kind of the driest portion of the presentation. So I do apologize, but again, it is very good stuff to know, because essentially that is the building block of where you're going to base your investments out of, and essentially it does directly affect and correlate to how much money you can add in to start making the tax-free or tax-deferred gains that you're looking to do as well. So with regards to the types of investments that you can do underneath of a self-directed IRA, any of these types of investments that are on here can all be covered by that red single member LLC, and I probably should have put trust in there as well, or for this presentation just called it checkbook control. Essentially, when you are looking to take the checkbook control and actually utilize it underneath of a self-directed plan, you are taking all of the money and parking it in this vehicle, whether it be a trust or an LLC, that subsequently will go and purchase the real estate, will loan out the note or mortgage, will buy the private stock in that company, or trade futures, or do some type of other investment. John asked, and I do love this question, I'm actually working on building our platform for doing digital currencies like Bitcoin and Ethereum. Hopefully we'll be able to have something rolled out to our clients where we will have the relationships established for brokerages for cryptocurrencies here in about the next 6 weeks. Hopefully, again, it's a project I am actually directly working on. You can do it in an IRA, but you do have to have an administrator that can administer that type of asset. So just check back with us. Stay on our website. We will be getting something out for clients that want to do these types of investments in an IRA. We will be getting that out hopefully as soon as possible to help people invest in those types of assets. And subsequently, things like Bitcoin and everything else, if you do a checkbook control IRA, you might be able to get invested a little bit faster than doing it directly underneath of the auspice of the IRA directly, because they can just title it in the name of the trust or LLC without actually having to do it directly underneath of the administration of us, as you would if you didn't have this type of investment option. So what we're going to cover in a minute could actually help you get involved in things that are a little bit more cutting edge, a little bit quicker. So for what it's worth, great question. Thanks for asking. We are working on it, but a checkbook control LLC or trust could probably make that happen, as soon as possible for you if you wanted to go that route as well. So with that said, instead of actually doing the investments directly underneath of the IRA, you could do them directly under a checkbook control, and everything on this screen can be accomplished directly under the auspice of a checkbook control entity. Now, there are a few things you cannot invest in, and like John just asked with regards to Bitcoin, there really isn't anything out there except for two very specific categories of investments that you cannot invest in. One being life insurance. The reasoning behind this is that life insurance contracts are typically always paid out tax exempt. So having it in kind of a cyclical circle underneath of a tax shelter, it doesn't really make any sense from the purpose of taxing it. So if it's already being paid out tax-free, there really isn't any advantage, and potentially could be heavy tax sheltering occurring if you were doing it under an IRA. So they don't allow life insurance. The other types of investments that they do not allow are things that base their value on subjectivity or extreme subjectivity, collectible things, antiques, rare bottles of wine, artwork, stamps, coins, things like that that don't have a readily appraised marketable value, like on the scale of real estate or tradable equities or notes and mortgages, things that can be readily identified as valuable. And even, you can certainly invest in things that maybe have a little bit more subjectivity, but this is what they're actually covering with that, is that it has to have the ability to be valued on an annual basis correctly. And just the last time I'll touch on the question of Bitcoin, the IRS did release publication that any type of cryptocurrency is considered personal taxable property according to the Internal Revenue Code. So thereby it does base itself for qualification to be purchased underneath of an IRA because it is not considered currency in the eyes of the IRS. So just like real estate and mortgages are considered taxable property, digital currencies, cryptocurrencies, Ethereum, Bitcoin are also included in that. So they have qualified it with actual rulings that they have put out for guidance on taxation. Now, covering the things that you cannot invest in, the people you cannot invest with. So there's certain people you cannot buy stuff from, and there's certain people that you cannot sell things to. Those people being anyone directly up from you and directly down from you in your family tree, including your spouse. The technical way of putting that is any direct lineal descendant or ascendant of you personally is not someone that can buy something directly from. You can partner with these disqualified individuals in a tenant-in-common purchase, just like you could partner with them on, let's say, the formation of an Checkbook Control LLC or Checkbook Control Trust as a tenant-in-common member or grantor beneficiary. So if you wanted to try to pool funds together with another disqualified individual, they couldn't necessarily buy into your LLC or trust, but you could from the onset have them partnered correctly and actually make that deal work, thereby helping you, keep being able to pool equity a lot better than you would if you were otherwise being directly prohibited from doing any business with them. There are a lot of ways that you can ask this question about how different things work and the mechanisms of disqualified persons and investing. If you have really specific stuff, I don't see any questions popping up, but give me a call because these things, the rules are very specific, they are far-reaching, and they can be a little bit complicated. So feel free to reach out to us with any disqualified persons questions that you might have. Okay, so we're moving out of the realm of the basis of this, of the base that you need to kind of understand where we're coming from when we're talking about checkbook control. Again, we're going to be getting into the actual case studies, the mechanics of the actual different types of investments here, how they differ and everything. So if you do have any questions, make sure you fire those off. This is where a lot of questions typically are going to be gleaned from. Excuse me, so please do make sure you are getting those questions asked. So what is a checkbook control IRA? It is an industry term that kind of encompasses a lot of different things, and essentially it more so covers a function rather than an actual type of entity. Again, it covers a function rather than an entity. So what does that mean? It doesn't mean that there's only one way to do this. Caesar, if you do have that, what type of transactions the DP cannot do. Essentially, you cannot purchase directly or sell directly to a disqualified person. You can only partner with them on newly acquired assets, and you can only sell with them if they're already involved in the transaction that you are involved with. So hopefully that answers that question. So again, it does not necessarily cover the type of entity at all. It covers the function of what you're actually accomplishing. It covers the actual removal of the administrator as the main controlling entity of the funds in the IRA, and then moves that into an entity that you or a designated individual has direct ability to direct those funds into the investments that you're doing. So a custodian administrator account retains the uninvested cash. So we would hold all of the cash for the IRA if you weren't utilizing checkbook control. Every single investment that you're doing, you'd be working with your dedicated account manager to make sure that everything is properly funded, titled, and record kept according to what you're actually trying to accomplish. Any sort of deposits or cash flow from those types of assets are going to be directly deposited to Advanta. So in simple terms, if you had a mortgage or if you had a piece of real estate that you funded in a self-directed IRA that we're directly administering, all the payments would just come back directly to Advanta. Either the borrower or the tenant would write a check back to us. It would go into your account. No taxes are paid. We don't charge any additional fees for that. You do get the added benefit of having us, record keep those deposits, record keep any sort of bills or anything that are being paid. So with a little bit more involvement, a little bit more administrative lead time, you also do gain a little bit of extra ability to have more records kept and an extra set of eyes on anything in case let's say you're not exactly experienced in doing self-direction and you want a little bit of extra help. The custodian administrator model might help you out a little bit. Everyone's not necessarily ready for checkbook control right off the bat. However, with checkbook control, you do gain a lot of things for what you're giving up. You gain the inherent tight control of your funds. So if you want to go to an auction for property that's being auctioned off for tax sales, courthouse steps, or you want to go to a tax deed auction, something that requires funds to be presented at the time of sale, or if you want to do a lot of stuff after hours networking in real estate groups, or if you want to make deals happen at off hours or on the weekend, you do need to have something in place that would allow for that. And checkbook control typically works very well with those types of clients that are looking to do those types of investments. So someone asked, does that mean that the client has to ask for approval for disbursements? It's not necessarily approval. It's just sending us the request for the distribution. So let's say you've purchased a piece of real estate and you need to have someone come out and do some AC work. You would just send us the invoice for the AC work and we would pay them directly. Or let's say you work with someone like a handyman that wants to be paid, immediately upon completion. Just have them provide an invoice and we'll send you the check beforehand, so that way once they finish the work, you can just hand them the check once they're done. So it's not necessarily an approval process. It's just more of a administrative process to make sure everything's being properly dispersed and also paid to the correct person. So the other elements of checkbook control are that you are choosing a specific type of entity to do the investing. So typically it's going to be an LLC or a trust that's going to be directly administered by an individual of your choosing. In some cases, you could potentially name yourself as the manager or a trusted third party as the trustee if you're utilizing a trust, in order to get these investments essentially transacted on a much quicker basis. The client personally obtains control over the cash, and you're going to be utilizing a third-party bank account. So instead of having everything record kept at Advanta, the only thing that we're going to be holding is just the record of $100,000 invested into ABC LLC for John Smith. We're going to essentially be holding zero cash, and the entity of your choosing is what's actually going to hold the cash that's going to do the investments. You can issue payments directly out of the account, and the LLC or trust would be directly receiving all of the income into that third-party bank account as well. So let's say sometimes you can't wait a day to get a check to someone. We can have checks ready same day, ready for pickup. But if you're not local to us, you might have some lead time in the mail. So if you absolutely have to have that tight control and tight payment, certainly utilizing something like this can certainly be a great benefit to you for that. So there's a few key components to looking at with regards to the two typical types of entities that people use for this. The two typical types of entities are going to be either an LLC or a trust. Now, the three components are going to be the investor, the management, and the actual document that actually creates this type of entity. So the investor is typically going to be titled in an LLC as the member, the equity holder of that particular entity. It's going to be the shareholder, the equity holder, or it's going to be the grantor in the trust, which we'll get to in a minute. The LLC also is going to have to be managed. So without lack of a better term, the manager, the officer, is going to be the person that's going to be making all the decisions, signing all the checks, and actually signing any sort of closing documents with regard to the investment that's being done through that entity. Now, the operating agreement is something that, even if you've set up an LLC before, you may not necessarily have experience in utilizing an operating agreement. In most states, you are not required to have an operating agreement to register an LLC to do business. In the state of Florida, where I'm sitting right now, you don't have to have an operating agreement. You just essentially have to have a tax ID number, which will allow you to apply for articles of organization in that particular state, which just tells the Department of Revenue or Labor, or whatever they are registering those LLCs under in that state, that you are now an entity in their eyes that can go out and do business. The operating agreement defines the relationship between the equity shareholder members of the LLC, the management of the LLC, and the disbursement of any sort of profits or other income from the LLC to the owners of that entity. So it's not necessarily something that you might always have experience with, but we at Advanta do absolutely require that, because it shows the IRA as the investor of that LLC and qualifies it as an investment under our eyes, so that way we can disperse the funds into the type of entity that you've chosen. Now, this certainly is not what type of the type of investing that you're going to, read about on CNN or MSNBC or Fox News or wherever, you typically get most of your market and financial information from on a news basis. This is something that is inherently very, small in its scope of the grand scheme of retirement plan investing. Is there an IRS filing requirement if the IRA is the only member? You would need to defer to any sort of CPA that you have regarding any type of specific filing that the LLC needs to do with the state that it's operating in. But for the most part, no. Since the LLC is owned by a tax-exempt entity, typically there isn't any sort of tax return that it has to file. There might be state filings that you have to do with the particular state that you file and register that LLC in, but typically that is more going to be a notification of existence rather than an actual tax return. So ultimately it falls down to CPA advice as to if you do need to do any sort of IRS filing requirement for that, but the answer is typically no. So with regard to the fact that this is kind of a very specific and very niche, for lack of a better term, type of investing, people want to know exactly where this type of thing has come from. Now, the strategy is laid out in front of you, but what about the legal mechanics of it? It's not something that a great deal of information is out there on by virtue of why we do these types of presentations. So I want to bring your attention to a couple court cases that were really seminal in establishing this type of IRA investing as qualified. There are some other ones out there, but these are the two biggest ones that are of note that will actually kind of allow you to do a little bit of research on your own end and read through these and see what they say. Before I get into the specifics of both cases, I do have another question. Let's see. Are investments considered to be loans? If yes, how fast to be repaid? An investment's only considered a loan if you actually loan someone money. So let's say in an LLC, you had an investor come up to you that wanted to borrow money. Well, that would be a loan to them. You would have a promissory note. You would have, if you had a recorded instrument like a mortgage or any other type of filing, it would be held in the name of the LLC. And with regards to term, it's completely up to you as to what type of term or period that the note will have. There isn't any sort of guidance saying, well, you have to have it. The IRA can only have loans out that are, going to be repaid in a certain amount of time. What I would say, though, there does have to be some consideration and have to be some type of period of that. I would be highly leery, if you will, of doing an investment out of an IRA that had 0% interest and no maturity date. So making sure that there is consideration being given in the form of interest and a period being established as to when the maturity of that note will occur is certainly something that would be a very good guidance on yourself personally looking at doing a type of self-directed IRA investment. So back to the court cases. The case that most people like to look for with regards to actually establishing the checkbook control function is one called Swanson v. Commissioner. It was back in 1996. And what it looked at was a couple different functions of Mr. Swanson in that he had formed an LLC that in turn was purchased by his IRA that operated in receivables that was doing investments and making returns. The IRS tried to say that it was disqualified because he sold shares of a personally owned company to his IRA. Well, they went to court. The IRS sued him for that and tried to disqualify the IRA. Well, since it was the IRS court found in favor of him, they said that because it was a newly formed LLC and the shares had not been assigned yet, then it was impossible for that individual to have sold or conveyed a personally owned asset that had essentially no previous ownership into his IRA. So they confirmed the actual, let's call it the structure of forming an LLC for your IRA to purchase in that case. There were a lot of other questions that were not answered, and typically when the tax court looks at something, they do not look at a broad scope. They look at a specific issue. The specific issue here was the issuing of shares of a company that had no ownership of it by the IRA owner to the IRA itself. They did not have a problem with that. Now, the other issues that potentially could be raised is that he was managing that LLC, and he actually did commit prohibited transactions in that case that they did not look at, such as that he was paying himself a direct salary out of his IRA-owned LLC, and he was directly purchasing receivable contracts from his personally owned business. So there were a lot of other issues they didn't address there. So I wouldn't necessarily point people to that case to kind of say it's the end-all, be-all of legislation with regards to checkbook control. The other interesting fact about that case is that he did sue the IRS, won damages, and they had to pay all of his legal fees. So kind of interesting, and a little extra on that. The other one is a tax court opinion in 2013 where Mr. Ellis was, in the course of an audit, found to have been committing a disqualifying transaction for the actual operations of his LLC. The IRS, in their scope of this case, did not have an issue with the fact that he was self-managing the LLC, but they did disqualify it because he actually lost the case on the grounds that he was paying himself a salary out of that LLC, which they did have a problem with. If you're going to be doing any sort of capacity of management of an IRA-owned asset, you absolutely cannot be paying yourself a salary for those services. It does cross a bunch of different rules with regards to the IRS. So that kind of maintains the majority of the information on LLCs and their components. The other type of investment structure that people can utilize for checkbook control is a trust. So instead of an LLC as the entity that will be the checkbook control vessel, they will use a trust. Now, trusts are extremely varied because trust law is written on a state-by-state basis for the most part, with the exception of some overlying guidelines that there is federally for trusts. So you have roughly 50 different sets of guidelines on how these things operate. But for the most part, we're going to be focusing on personal property grantor beneficiary trusts, where the grantor or the creator of the trust is also going to be the beneficiary. Now, translate that and what it means for the IRA is that the IRA is going to be the initial capital contributor or grantor of the trust, and will also be the sole beneficiary of any profits or assets of the trust as well. So grantor beneficiary trust makes sense. Now, there's many different types of trust. You don't necessarily have to use the standardized grantor beneficiary model for a personal property trust. People can use revocable trust. You can use a special needs trust or life insurance trust. There's a bunch of different ways to go about doing this with regards to doing it correctly. So don't think that there's just one cookie cutter shape that you have to use. If there's something you like or something you're being advised on, by all means, utilize that experience or that advice that you're receiving outside of the IRA to do it. The parties in a trust. I did just get a question. I will get to that in one moment because it is a good one. Parties in a trust. So just like, remember, in the LLC, you have the member, which is the shareholder or direct receiver of all of the profits and assets in the IRA being the LLC being the IRA, and you also have the manager, who is essentially the officer that will be signing all the checks, managing the affairs of the LLC, and doing all the day-to-day business of it. In this case, again, the grantor is going to be the capital contributor and is going to be the actual owner of the trust. The trustee will be the manager in this case of the trust, and we at Advanced do not allow clients to name themselves as the trustee. A trustee inherently does qualify as a fiduciary, meaning that they are required by law to act in the best interest of the participants of the trust and the trust itself. The IRS does regulate that you cannot act as a fiduciary to your IRA directly. It is a business decision. You can name, whomever else that you would like to do that, and you can include functions of things such as requiring letters of directions and approval from you as the client before the trustee will make or enter into any sort of financial agreement. So you can protect yourself if you are concerned about the powers of the trustee has. There are different ways to structure these things to make sure you, ultimately are the one that has the last say in how your money is invested and managed. Okay, I've been told that, and here's the question, I've been told that a checkbook IRA is much more likely to be flagged for an audit by the IRS than the basic type of self-directed IRA. Is there any validity to this? In my In my professional opinion, I would say no. Simply, and there's a couple different reasons for that. One, the IRS really has no idea who has these things. Essentially, when you file any sort of document with the state, let's say with the Department of Revenue or corporations or whoever that is, you're only telling them that there is a single member LLC that's registered in that state to do business. They have no idea who the owner of it is. They just need to know whom is managing it, what the tax ID of that actual business is, not the tax ID of the IRA, and also who the registered agent is that will be receiving legal notifications directly pertaining to the LLC. The reporting that Advanta does, or any IRA administrator does not include ledgered accounting of what the IRA holds. So, with the exception of actually getting audited or, the IRS finding out that you're doing something outside of that, I just don't personally see there being any way for this to increase or decrease any sort of audit risk. The IRS Form 5498 simply just reports a value on an annual basis to the IRS. It doesn't give them, let's say, for example, my personal IRA that I have different stocks in at Fidelity. They just know I have a Fidelity account. They don't know that I own Facebook and Apple and IBM and things like that. So with that said, I just really don't see, essentially how that it would ever really increase an audit risk. And have I seen anything that would increase that? No. Great question. Another question. Doesn't the IRS consider a single member self-directed IRA as a disregarded entity and that does not require the filing of a tax return for the IRA LLC? Inherently, an IRA is a disregarded entity from yourself personally. The basis on not having to file a tax return for the LLC kind of falls down to a couple different functions. Yes, there is some basis in the disregarded entity argument of being exempted from having to file tax returns. However, there are specific areas where an IRA might have to file a tax return, namely being, let's say that LLC took out a non-recourse loan, you would be subjected to tax that would have to file a tax return for that LLC. So just inherent in the basic structure of the LLC, typically 9 times out of 10, no, you're not going to have to file any sort of tax return, but if you do have qualifying investments or liabilities, you might have to. So it's not kind of a blanket statement, but it is, good to know that it doesn't always just necessarily preclude itself from having to do any type of returns. Okay, we got some good questions rolling in here. Okay, we answered that one. Doesn't answer that one. Okay, one. I believe the IRS would question a setup if there was a rapid, unreasonable growth of the balance. Well, you can make a couple different arguments to that, and it's definitely a good point to bring up. So let's say someone in a brokerage account had invested in several IPOs. They had $100,000 from a 401k, and let's say back in 2012 they bought Facebook stock at its IPO price of $15 a share. Well, now it's trading at like $145 a share within 5 years. So if you take 100,000 and multiply that out, that's huge growth within a short period of time. In my mind, I don't think many people would think that doing stock trading would inherently raise a risk of an audit and a brokerage account. I mean, it's fairly common. I would say that if you have huge growth of any kind, whether that be personal, qualified plan, or anything else, that yes, I mean, if it is values reported to the IRS, you might be looking at audits for various reasons. But I don't think that an LLC, in this case, considering they have no idea what you have in the IRA, would necessarily drive you more towards an audit risk than anything else. It just depends on the way you look at it. And I'd say typically most of the time that if it's, the reason that people think this is inherently more likely to get audited just because it's different, but the IRS doesn't get any sort of notification about the different types of investing you're doing. So, it's just something to think about. There really isn't any definitive answer to that, but it's a great theoretical one to bring up. Thank you. To clarify the question, does the fact that the single-member LLC make it more likely to be flagged as compared to a multi-member LLC? Again, the IRS doesn't get any report of the type of LLC it has. In all honesty, I am not the person to ask with regards to corporate audit risk type things. I don't know if single-member LLCs get audited more often than multi-member ones. It's just something I certainly will try to go figure that out for you, but I just honestly don't know. And in a general, not even a specific IRA, if that applies. Okay, we get one more, and then we're gonna roll on to some case studies. Okay. Okay, would it be a prohibited transaction if the owner of the self-directed IRA ultimately had a downline benefit from the transaction? An example, a realtor holds a self-directed IRA and loans the funds to a buyer to purchase the property. The buyer uses the realtor's service to purchase the home. The profits of the loan go into the IRA, but the realtor would personally receive a commission. Great question, and yes, if you are a realtor, which a lot of our clients are, certainly use your professional knowledge, experience, direct plug, if you will, into the marketplace to help find good deals and help make things happen. But with regards to you taking a personal commission, I extremely encourage you not to do that. Make sure that you are not taking any sort of direct personal benefit. The IRS, in as many different shades of gray as they like to operate in with regards to their regulations, is very clear on the disqualification of any sort of direct, excuse me, take some water. Any direct personal benefit that you would be receiving from the actions of your IRA. So with regard to the fact that something being done in a trust or an LLC, if your IRA purchased property and you were to take a commission as the realtor for that, without giving legal advice, I would say I would be highly, highly, highly on the side of that being a disqualifying or at least a heavily penalized event for that. So if someone has to take a commission, get someone else that you know to act as the buyer's agent for that. Try to negotiate a reduction in the cost of the property so that way you're netting out a savings instead of taking a personal commission. There's ways to make sure that you're doing it right, and certainly that is a good question about utilizing personal experience and in the real estate field to potentially accidentally cause a issue to happen. If you do have any questions regarding what we charge for our services, please just email me afterwards. I am certainly happy to review that with you on a case-by-case basis. Let's see. In that case, the only direct benefit allowed is a distribution of assets from the IRA to the client. Yes, essentially the only way that you can directly benefit from IRA-owned assets is to take it as a distribution that is reportable to the IRS. I do believe that answers your question. Okay, case studies. Again, keep asking questions. Great questions being asked, but we do want to make sure that we don't go over time, which we probably will by this extension, but let's get through some case studies so you see how this stuff works. Okay, in this case study, Joe has a traditional IRA, $150,000, and he's interested in real estate. So he decides to purchase single-family rental properties. He finds a house that's $100,000, needs $20,000 worth of rehab work ready to get it to rent. Fairly basic real estate deal. Obviously, with the increase in market prices, these might not be as average in your market as it is here. He projects the property will net cash flow of $1,000 a month after rent. So how can he do this? Well, there's 3 different ways you can do this. The first way would be to complete an IRA application, roll over funds, and get the account open with Advanta. A contract would be written in the name of the IRA. We would sign the contract, and again, everything that we do here doesn't inherently take a long time with an approval process or anything. In the IRA administrator model with this, contracts are signed within a few hours. If we have closing documents in good order 48 hours prior to closing, we absolutely will make that closing date. Typically, we can get stuff done in a quicker amount of time than that, but it's not like you have to schedule in an additional 3 or 4 weeks into a closing. We can make stuff happen well under 15 days if we have funds in good order and documents. It's definitely not a problem. The escrow deposit is going to be issued from the IRA. All the documents, HUD, deed, title commitment, estoppel letters, prorations, are all going to be titled in the name of the IRA for the closing. So with that, we as the IRA administrator will work directly with you to make sure everything is done correctly, and ultimately the deal is funded and closed in the IRA. So at that point, Joe secures a tenant, directs us at Advanta here to sign the lease, and then all of the expenses are going to be paid directly from the IRA. So taxes, repairs, anything like that have to be paid directly from the IRA. And it's as simple as just submitting us a request for payment, and it's processed same day if it's here before 12. The growth and any sort of income come directly back to the IRA, and he can continue in perpetuity to hold that IRA property just to have net cash flow, or he can sell it for an appreciation in the equity in the property and then go find another deal as well. A simple example is that, like I said with Facebook stock, buying it at 15 and selling it at over 100, you can do that, or you can continue to hold it and participate in the growth of that. The examples here are really not going to be any different with the core investment strategy. It's just the type of investment that you're doing and how you structure that in the IRA is really what's changing here. Okay, so how does that function within a checkbook control account? Well, it's still being done in an IRA. The tax qualifications are all still the same. So where do the differences come in? So the very beginning of the account is exactly the same. Joe completes an Advanta IRA account application. He moves funds over from the 401k or the IRA, again, using either that direct trustee-to-trustee transfer or the direct rollover, depending on where it's coming from. Now, in this type of account, there is no direct involvement with Advanta to the real estate closing. So what they're going to do is that Joe's going to choose the LLC that he'd like to use, whomever he'd like to have draft that operating agreement, and they're going to pick the state that he's going to register it in. The articles should not be in the name of the IRA. They need to be in the name of whomever's the manager, if that's Joe or some other individual acting as manager and registered agent. The operating agreement's the only thing that needs to have the IRA's name on it, just as the member. So the IRA is the 100% owner. The operating agreement shows this. The member is going to be titled as Advanta IRA for benefit of Joe Smith IRA and his account number. Now, once we have all of those documents, we send all of the money directly to the LLC. So the manager of that LLC has established a bank account in the name of the LLC. The IRA, once we get all the paperwork in order, so that's going to be our general waiver, our bidirection form, and a copy of the operating agreement that the client has approved, will issue the funds directly to the LLC. Now, once the funds are at the LLC, that's when the checkbook control functionality occurs. So Joe, in this case being the manager, will be signing the contract for the on behalf of the LLC for the real estate closing. He'll be attending closing, signing any and all documents, again, settlement statements, approving the deed, approving title commitment, signing any prorations, signing any estoppel letters, things like that for the asset in order to move to closing. Now, once it is closed, all of the rents from the tenant, if it's a rental property, will go directly back into the LLC. All of the expenses, taxes, and insurance are going to be paid directly from the LLC, not by the IRA. Again, the IRA has completely funded the LLC. And just like with the IRA, the strategies can be varied. He can either hold it and continue to net cash flow in as rents, and then he can sell the property for a profit. There isn't a whole lot that changes between a structure of using the trust versus the LLC. The essential functionality of how it works from a procedural perspective is the same. Essentially, you got to start with opening the IRA and funding it from a qualifying account. Instead of providing Advanta with a copy of the operating agreement, you need to provide us with a copy of the trust agreement. So the trust agreement needs to name the grantor and the beneficiary as Advanta IRA, FBO, your name and account number. This is not a publicly recorded document. There isn't any sort of record on the public registers of any sort of trust capacity. I mean, unless a trust has to file a tax return, there isn't any sort of annual articles or additional annual expenses that you're going to be incurring with a trust, unless you have some sort of a rental agreement with whoever provided your trust document, which is exceedingly rare. Typically, you purchase the right for that. Now, Joe must read and approve a copy of the trust agreement, just like he did with the operating agreement for the IRA. And then once everything is funded, the trustee is who's going to be signing settlement statements, contracts, and everything else regarding the closing. And then once it closes in the name of that trust, the trust, and by extension the trustee, will be the one that collects rents, signs rental agreements, and everything like that. So the trustee will be the actual one that is going to be coordinating the actual management of that entity. Okay, pretty much covered that. Okay, a big thing that people absolutely need to take away from this is that how do you take money out of a checkbook control account? There is an absolute wrong way and an absolute right way to do this, and there's no bleed over from one to the other. The correct way to take money out of an LLC trust or an LLC, or sorry, a checkbook control LLC or a checkbook control trust is to take money from the entity. So in this case, Joe's LLC or trust would write a check back to Advanta that would be deposited into the account. This does not go against any sort of contribution limits or anything like that. This is just a distribution to the members or a payout to the beneficiary of the trust. So it's just profit from the actual investment that the IRA did. At that point, you can request a distribution of those funds either to yourself personally, or you could potentially have it moved to another administrator if you wanted to do something, let's say equities or bonds. That's the correct way to move things from one account to another or to take the funds personally. You absolutely cannot just write yourself a check out of the LLC or trust. Again, that is how the tax letter in 2013, T.C. Ellis, that's how the big issue and disqualification of his account occurred, was that he was paying himself a salary, or you could make, the extension of, any type of direct payment that you would be getting as the account holder from one of these entities without going through the proper reporting channels and steps would equally cause a same amount of problems. So just remember, it has to go from the entity. Sorry, change it real quick. It has to go from the entity to Advanta to whomever else needs it. Okay, got a good question. If the LLC needs additional funds, does it just request Advanta to issue a check from the IRA account? Essentially, in the most basic terms, yes. If the IRA still has additional funds and a single-member LLC, you just complete a copy of our investment waiver and our bi-direction letter, and we send the money directly to the LLC or trust. Let's say the IRA doesn't have additional funds, you could make a contribution for that in turn and then to be moved to the LLC or trust, or you could do a direct rollover or a custodial transfer to move money to the IRA to in turn move into the entity. So yes, that is the correct way to do it in reverse. If you ever do need to put money into the LLC, don't write a check personally in there and just deposit it to the LLC or trust. It has to go to the IRA first and then in turn be moved to the underlying entity. So thank you very much for that question. Okay, so there are inherently some pros and cons. I know we are running a bit over time, but we are just about done. We have another probably 5-10 minutes left, and then we will make sure we get you out of here. And again, keep asking questions. The questions that have been coming in are really good, and I think adding a lot of enrichment to this. So there are some pros and cons. The pros of using a administrator directly, so not using checkbook control, is that essentially you're always kept at arm's length from your IRA funds. You don't have to worry about, crossing into a threshold of an area where you don't need to be. We're going to be looking at everything, and if there's anything that is a huge red flag, we will let you know and make sure that you have the proper tools in order to avoid that, or to, restructure something if need be, or if we need to refer you to legal help to get, on the right side of an issue, we'll certainly do that. So essentially, you are very much less likely to engage in a prohibited transaction, although you're not completely immune from doing so because we don't have all the details of every single thing you're doing. An example, we had a client that accidentally rented his IRA-owned property to his daughter. His daughter had a different last name than him. He didn't notify us of the relationship between the two people, and ultimately, that's how that happened. So, you do need to still be cognizant of the rules, but if we had seen that lease with the same last name of someone, it is our policy to ask their relationship to you and make sure small stuff like that doesn't cause a huge problem for you down the road. You also do have a lot of additional records being kept because we are going to be the ones issuing any checks for expenses out of the IRA and also getting any sort of income from the investments as well. Some of the cons is that you could incur some additional administrative fees. So you are charged the exact same amount if you have 10 assets or one asset in an LLC. However, you would pay potentially more money if you had multiple assets directly under us as the administrator. There's more work that we have to do and more services that we're providing. So depending on what you're doing, the LLC can not only be a tool to help you get your administrative workflows greatly improved, but it can also be something that you use to help mitigate your fees as well. The other con to the Advanta, the administrator model, is that you have no ability to write checks immediately for purchases. As we covered previously, things like auctions and doing deals on the weekend or late night, those are the kind of things that you're really going to see the big advantages of while utilizing checkbook control. Now, what are the pros and cons of using checkbook control? It's not all perfect. There is some inherent disadvantages to it. The pros are you have quick access to funds, you can hold more assets with lower fees, and you have a greater ability to to have personal anonymity with regards to your investing. Some of the cons is that you are going to be solely responsible, or the trustee is solely responsible for keeping all and accurate records of the investments that you're doing. You have a lack of oversight from us as the IRA administrator and using our many years of experience in doing this to help you avoid problems, and it can be a little bit easier to engage in a prohibited transaction. I tell people, just because you are essentially removing Advanta from the equation of the day-to-day operations of your IRA, don't involve us any less with regards to your questions. Feel free to pick up the phone and ask us a question if you're going to be doing something new that you're unfamiliar with. Give us a call. I mean, we're always happy to help you out with that stuff and make sure that ultimately at the end of the day that you are getting the best benefit out of our service and the best benefit out of what you're doing as well, while still maintaining on the correct side of any rules. So, use this as a resource. Even if you're doing checkbook control, we're always happy to answer those questions. And ultimately, it boils down to which investment model is right for you. That's really not a call for us to make. That is something that you need to consult with a tax advisor or attorney with. And it's ultimately something that really needs to be made as a personal decision that is done by you and your advisors. And with that said, it pretty much does bring us to the does Advanta consider the investments into the LLC to be cash asset for the purpose of charging fees? Not exactly sure how you're asking that question, but essentially the LLC is just considered an asset. There really is no difference in the cost basis for cash. Whether you're doing something at Advanta directly or not, we don't charge for undirected cash, so we just consider it to be an asset. Whether we don't charge any difference if it's real estate, a mortgage, or an LLC. It's considered a singular asset. And with that said, this does kind of bring us to the end of our presentation. How to get started. Again, it's either going to be done by essentially a direct rollover or transfer to fund the account and then choosing your investment. And always feel free to consult with us. We don't charge by the hour like a CPA or an attorney, so feel free to give us a call. We might be able to whittle your questions down to a point where you're going to be, when you do have to make the call to your CPA or an attorney, you are paying as little fees as possible, so you don't have to have an hour-long conversation when you only have a 5-minute question. So here's all my contact information up there for you, my direct line and my cell phone and my email address. Feel free to reach out to me. I am always happy to answer questions. I thoroughly enjoy what I do. I've been, Friday will be my 5th year doing this with Advanta, so I thoroughly do enjoy getting out there, educating people, helping people make the decisions that ultimately help benefit them the most in their retirement. So please do feel free to reach out to me with any questions that you have. I'll stick around here for a few minutes, going to end the recording.